I want to talk to you about the financial ratios as a separate piece before we do the balance sheet real quick. Um, so for the on your own part, you guys were working with a plumbing company, and that should be the answer. All right. So our total expenses, net income down here of 2,386. That would be these ratios here. If you're looking at it, the total expense ratio was 29.8%, and the net income ratio was 70.2%. So I just want to talk real quick about what these numbers and stuff actually mean and why you would use them at all. So when you're talking about analyzing an income statement, um, you are essentially analyzing revenue and expenses, and you can use these different financial ratios, and there are a whole bunch of financial ratios out there. Okay, debt to income ratio, profitability ones, all that stuff. This is a profitability ratio. These two ones, you want to know how profitable the business is, but it's a key thing that helps you analyze the health of the business. So, why don't you guys tilt screens down and put your phones away, please? Give me just a moment. I apologize for the lecturing. I know, but hopefully the rest of this week won't be like it. So, um, anytime you compare two components of any sort of a balance sheet or any like financial components, it's called a financial ratio. And when you use those ratios to interpret numbers to make business decisions or to analyze the health of a business, it's called ratio analysis. And specifically, the ones that we're looking at are called vertical analysis because you're comparing things back to something kind of vertically. And it just, that's what it looks like. So um, we use two ratios here, total expense ratio and net income ratio. And we'll learn this net income ratio has another name to it as well. And especially since, like I said, we use net income because profit is not fully defined here. We don't know how much during the year that Delgado Web Services paid in taxes. We don't know under some of his loans. He might have had a loan, for somebody, then he would have owed some interest on that as well. You'd have to take that out too. He doesn't really have any like property, plant, or equipment. Sometimes that goes into it too. They take that sort of things out, these durable goods. Anytime you have any depreciation of good things, so like he would have bought some computers and stuff. Some of his assets would probably have been like a nice laptop or some computer processing stuff, right? And those computers break down over time. We know that computers don't last for a long time. So over time, he would have a depreciation expense each year. And eventually, over the course of maybe 5 years, that computer would be fully expensed out and become deemed, worthless. Now, he could keep using it as that, but he doesn't charge the entire, say he spent $2,000 on a computer, he wouldn't just charge that whole thing in the first year, right? You space out the expenses over the life of the actual thing itself. All right. They do it with cars all the time, computers, manufacturing machinery, and all that kind of stuff too. Things that last a long time, but not forever, would be like that. So we're going to call it net income ratio. They call it net income ratio, but really what it is it's a return on sales. And so return on sales is a really, really, really important ratio, and I'll kind of explain why in a second. So, um, financial ratios in general, though, allow businesses to compare their percentages. So, this is how you would use it. Looking at it alone, you don't necessarily know if it's a good number or a bad number. Okay. Essentially, what it tells you, though, is how much of your expenses for up here. So, what is the expense? What is the percentage of your expenses compared to your sales? So, for example, this is 45.7. If it were really high, it could be a bad thing, right? It just means that you have a whole bunch of expenses and you're not really getting anything back from sales. Okay. And then same thing down here. What is the percentage of your net income in terms of sales? And it's again, it's a ratio that allows you really to compare it to industry standards. And so I'll show you an example of this because I found one for the plumbing example that we just did. Industries, there's a whole bunch of different industries: financial industries, service industries, manufacturing, merchandising, whatever, all have published benchmark standards that you can compare your numbers to see if you're doing well or not. Are you above or below them? Okay. If you are above or below, depending on what type of ratio it is, it might be a good thing or a bad thing, right? If you're supposed to have a low expense ratio, but yours is really high, that's a problem. Okay. But some industries have a really high expense ratio. And so you have to compare it to other businesses. You can also use it to track uh, per year. All right. So per year, what was your total expense ratio? Did it go up or down? Are you spending more to create sales or are you spending less? Hopefully, ideally, as your company grows, your goal should be to increase that last one, the net income, because you want because the higher the ratio, the more profitable you are. Likewise, you'd probably want to decrease your expense ratio over time if possible. Okay, find out where you can cut expenses so that you increase that profit margin. Um, so, like I said, this the last one that we looked at, the net income ratio, is also called the return on sales or the operating margin ratio, and that's how it is calculated. It's the same calculation that you guys just did: profit or sales divided by the net income. Okay, or in this case, they call it different things as we get more refined in these. This would be like a corporate example: operating profit divided by the net sales revenue. So, this is just like saying. The net income divided by net sales or your total revenue or whatever. Here's an example, but I won't go through that. Let's just go back to looking at this example here that we looked at. So we have the plumbing solutions. They had a total expense ratio of 29.8 and a ROS or return on sales roughly of 70.2. All right. And so that seems pretty high. All right. If your profit margin is that high, that seems like it's pretty good. But what you would do is compare it to other industries. So this is a plumbing industry. I just looked up, there's this website called Ready Ratios. And if you look up the industry that plumbing is in, it's in the hardware and plumbing and heating equipment ratios. You can see published ratios for what this should be. And so if we go down, operating margin, return on sales, in 2020 should be 3.2%. Now, remember, we're not getting a full picture of this because currently we're not including anything else like depreciation expense, income, or interest expense, taxes, anything like that. So this number would go down if we kind of had the full picture, but it still seems pretty high. Also, I think these numbers in this Cengage MindTap thing are pretty arbitrary. This I don't think would be like an exact, uh, you know, income statement for a plumber, but regardless, you could compare your numbers to the industry standards and just see how are you doing. All right. If you're higher than the industry standards, that's a good thing for return on sales. If you're lower, you might be looking to cut expenses or increase your profit margin somehow. All right. If you're an investor, which usually for a service business, right, it's not like a plumbing bill. You're not going to invest in a plumbing business, but you might invest in a very large plumbing corporation that has a lot of different contractors. Um, these are numbers that would make a big deal. They would make a big difference in kind of your decision-making process. So that's just a little bit of a background on these financial ratios and why you would use them. So if we're looking at this plumber, if it is true that this is 70.2% and the industry standard is 3.2, we would say this business is doing very, very, very well, right? That's a good thing. That's a good margin for right there, especially when you compare it to this. Now, if it starts to go down over time, the owner of this business might ask themselves why. Is it just that things are getting more expensive and they have no control over the inputs that go into their business? Or is it that they um, are spending more money on things that they can't? Like, for example, if insurance just goes up, there's nothing you can really kind of do about that. If supplies that you use to run your business go way up because of shortages and stuff like a lot of businesses are seeing now, there's not much you can really do about that. If utility costs go up, if you maintain a building, they're expecting heating and gas to go up this year by like 30%. There's not much you can do about that, right? But you need to look at this stuff and make those decisions kind of as a business owner.